So we just want to thank you for taking the time to watch this video. As we sort of settle into 2021, we want to take a look back at the last 12 months or so from an economic perspective and see what have we learned, if anything, and how this affects our expectations for the year ahead, particularly obviously from an investment point of view. One thing we have learned is that making any kind of plan for the future, you now need a lot more out of the box thinking. None of us expected the worldwide pandemic that happened when we heard about this virus in Wuhan. And again, none of us expected economic markets to recover and rally following that massive drop in March last year. So, again, we just want to look at what drove that recovery and that subsequent rally. And is there any reason to believe that this could continue in 2021, 2022? As mentioned before on previous videos, this recovery came largely from that massive, unprecedented financial stimulus from the developed world, particularly the US. And this cheap money had to go somewhere, since bonds and cash giving zero or in some cases negative returns. Money had to flow into the stock market and mainly to the shares of the future, those big tech companies. So much of those shares now are valued at many multiples more than the actual assets that they're based on, assuming you obviously ignore future potential because that's what sort of the hope is. And then after this monetary stimulus started to wear off, again, this hopefulness was reignited by vaccine success stories and now the actual vaccine rollout around the globe. And much of this optimism has been focused on specific areas of economies, as mentioned, these tech companies mainly, and has often completely ignored large areas of the economy that's had a terrible time since the outbreak of the pandemic. So the question is this sort of model sustainable? Well, the real economy, the economy where decade old companies have closed down, where there's been these massive retrenchments, will that economy finally affect the investment market and cause a massive correction or drop in investments in 2021 or next year? Will the trillions of dollars, around 15 trillion that was pumped into the system just in the first 9 months of 2020, that's dollars, will that debt actually catch up now with the economy that has to pay back all that money? And again, for those tech companies that have been the large drivers of the higher value, particularly in the US markets, many are speaking about that in similar terms as the tech bubble, the dot-com bubble of 2000. Many of those companies are no longer around. If there is a company with .com in its name that's still around, well, you know how old it is. Besides that, though, the US government has already started to make moves to force these major players to restructure their companies to avoid monopolies, all of which could have a large effect on those shares that are carrying the stock market to a large degree. So those are nerve-wracking realities, but there is also some other separate positive news. The monetary stimulus in the US was based mainly on lower taxes, lower interest rates, effectively putting cash in people's hands. And as mentioned, much of that ended up just going to the stock market, pushing up those prices. And not enough was used by consumers to actually spend on stuff, which is what actually drives growth again. And another thing, much of it was saved. Around the world, savings levels have actually increased dramatically because suddenly that rainy day is a lot more on our minds. But none of that drives actual economic growth. But interestingly, the $2 trillion that is scheduled to be pumped into the US economy now under Biden is not just monetary policy, but fiscal stimulus, which is actual government spending on infrastructure, on roads and things, which is positive. That pushes growth. There's also some expectations that with less tweeting confusion, slightly more responsible behavior, they even talking about potentially these trade wars between the US and China coming to an end. Interesting. That's something to watch. So additionally, as vaccines are rolled out and people start to feel some semblance of normality returning, much of that rainy day money will likely start to be being spent, which again actually drives real economic growth. And we actually have seen evidence of that in some areas of the economy. You think of residential property markets and things like that. So with all these factors floating around, what are we actually saying for the year ahead? Well, 2021 does have potential for positive growth, although it's unlikely to come from the same drivers of growth as last year. And so being invested in the winners of last year is a worry. And our FinBofs.com portfolios are specifically weighted to value managers who are set to hopefully benefit from these pockets of real economic growth. There will also most likely be some nasty surprises. Many of areas of the economy, locally and offshore, have still not realized the full effects of all those lockdowns. So again, our portfolios are currently a bit more conservative than they would have been perhaps a couple of years ago. We just believe this year being slightly more safe than sorry is the way to go. From a global perspective, growth, professionals are saying they're expecting it to mull around 4%, assuming obviously this vaccine rollout goes according to the average plan, which is a massive assumption that can change dramatically if that vaccine plan changes. And locally, we know there's a lot more at play. The budget speech coming up tomorrow has been hailed as one of the most important in history. So focus areas will obviously be the vaccine, government wage spending. Will they continue to bail out these SOEs? Any potential tax changes and actual real growth initiatives to push GDP growth? All of this will have a massive effect on government debt, which is really almost at a cliff at the moment. And that could ultimately obviously all have an effect on our South African pockets. So to be honest, we'll be surprised if there's any real amazing fireworks. We believe markets have already priced in a sort of very middle of the road outcome. But obviously, there is potential that from the very, very low base that South African markets are, it wouldn't take too much good news or good action for it to have a very big positive effect on those South African shares. So our portfolios are exposed enough to that to at least not miss out if that does happen. Then South African GDP growth, they're saying, is expected to hover around 2%, which is obviously not enough. But a little bit of positive action, as mentioned, could make that jump significantly, which would obviously make a big difference. So yeah, that's just giving you an overview of how we see the year ahead and idea of our stance when it comes to approaching your hard-earned investments for the year ahead. And we just want to take the opportunity to really, really thank you for, particularly our investment clients, the confidence that you have placed in us so far. It's actually been a very positive year for our business. So we really want to thank you very, very much for that. We can't wait for the time when we can meet in person without any fear of being infected. But until then, just please stay safe. More importantly, stay sane, and give us a shout if you at any time have any questions. Thanks very much.